So that I have shared, sir.
Sharmila ma'am. Sharmila ma'am.
Yeah, ma'am.
Ma'am, Nilima ma'am has asked us to share that short video in our status, right? WhatsApp status. But it is getting uploaded only till 6th, 7th and 8th. By the time is up. It's just a 1 minute video, right? What we can upload there in WhatsApp status.
Ma'am,
If
1
you put
minute.
that,
Ma'am,
the whole video doesn't cover. Only till 6th it comes.
Okay, ma'am. 1 minute, Vidya, ma'am. Hello.
Okay, fine.
Sharmila ma'am. Sharmila ma'am, Vandana is there, let her in.
1 minute, ma'am. 1 minute.
Okay. Yeah.
Juhi, ma'am, I have noted. I'll make her. Vandana, ma'am.
Ma'am, you can hear me, no, ma'am?
Yeah. Yeah.
Okay. Joy, ma'am, did you set your screen?
Yeah, I have done that.
Okay, I'll just do it 1 second.
What I'm telling you is,
Hmm.
sir is not going to come as ma'am told.
Fine.
Sharmila ma'am, can you all hear this? Everything can be is.
You want me to stop this share?
No, nothing, ma'am.
Oh.
Joy, ma'am, I know sir is not coming.
Okay, so you'll take care of that.
Yeah, so we don't read his profile, no, JJ?
Yeah.
Correct, yeah.
But ma'am told that something Smita ma'am told you. Ask Smita ma'am. No, Smita ma'am is not here. You have to call and ask ma'am.
I'll talk to ma'am. I'll just check. I'll just set my virtual background and then I'll start.
Okay.
Nandan sir. Nandan sir. Sharmila madam.
So tell me, sir.
Nandan sir,
Yes, yes.
Sir, ஒரு சில students வந்து
could
அந்த
you,
start byteல
could you
join பண்ண
please
முடியும்.
check that video?
I'll try. Teachers, it's already live in
Sir,
YouTube.
Murli sir,
Students have started accessing it. In case if there are any students who are unable to join through StockBuy due to registration of OTP or something, please hand over them the Zoom link.
Ma'am? Sharmila ma'am?
Smita ma'am, 1 minute ma'am. Yeah, Smita ma'am.
Ma'am, virtual background.
1 minute ma'am, 1 minute. Actually,
Yeah.
didn't share properly. I'll check.
Yeah.
Smita ma'am. Juhi ma'am.
Yeah,
Ah.
ma'am.
Tell me.
Fine.
Yeah, this is fine.
Yes.
Okay. Thanks, ma'am. Haan, Juhi ma'am. It's fine. Yeah. More than this, we can't show, no?
Ma'am,
Haan ji, ma'am.
check the group message, ma'am. 1 second.
I'm checking. A very good evening to everybody present here this evening. A few general instructions before we begin the Global Summit. Requesting all participants to keep yourself on mute at all times. Please note that this is a 5-day Global Summit and attending the summit for all 5 days is mandatory. At the end of each day, a feedback link will be sent to you on the chat box. Do not forget to fill the feedback link. Once the feedback link is filled for all 5 days, a certificate will be issued to all the participants. Participants kindly adhere to the general instructions. Thank you. Education is a human right with immense power to transform. On its foundation rests the cornerstone of freedom, democracy, and sustainable human development. Kofi Annan. A very good evening to everyone present here for a 5-day virtual summit on the global securities market, the changing landscape. I, Vandana Talreja, Assistant Professor at School of Commerce, on behalf of the Faculty Research Cell, Samshodhana, Jain deemed to be University, Bangalore, in association with Stock Market Institute, Bangalore, deem it my honor to welcome all our principal officers and guest speakers. Dr. Raj Singh, Vice Chancellor, Jain deemed to be University, Mr. Kishore from the Stock Market Institute, Mr. Jamie Coots, CMT, CFTE Crypto Market Analyst for Bloomberg Intelligence and Board Member with the Cmt Association. I acknowledge the support and guidance of all the other principal officers in absentia. A very warm welcome to the heads of various departments, coordinators, fellow colleagues, and all participants to this August gathering. Jain deemed to be University, an intellectual destination that draws inspired students from more than 38 countries to India's Silicon Valley, Bangalore, has been established with an aim to provide quality education and entrepreneurial development. A culturally vibrant campus consisting of students from various states has contributed to the rich academic traditions of the university. Over the years, the university has made conscious and concerted efforts to build on its strengths and consolidate its achievement. Certified ISO 9001-2015 for quality management by TUV Nord, Jain deemed to be University, is a member of Association of Universities of Asia and Pacific. Jain deemed to be University has also been awarded 5 stars in the Young University category in Karnataka by KSURF iCare ratings. Jain deemed to be University has received graded autonomy status by the University Grants Commission, and the grant has been awarded based on its accreditation given by the National Assessment and Accreditation Council, NAC, that is A++ grade with a CGPA of 3.71. School of Commerce, empowerment of students, enhancement of values, and enrichment of academics and research has been the hallmark of the School of Commerce Jain deemed to be University for nearly 3 decades now. The constant innovations nurtured in its various spheres of functioning, which include global tie-ups such as ACCA, CIMA, CMA, CIPS, etc., and experiential learning practices like student immersion programs, entrepreneurs in training, and business simulations, amongst others, have characterized the growth of the School of Commerce over the years. School of Commerce has a dynamic set of experienced and research-oriented faculty members who draw various students from various countries towards a keen learning environment. In the most recent India Today ranking, the School of Commerce has secured the 43rd position and the 6th rank in the top 10 emerging colleges of India, and the 8th rank among the top 10 colleges with the best placement record. This global summit is planned and executed by the Faculty Research Cell Samshodhana. The Faculty Research Cell Samshodhana is an initiative of the School of Commerce, deemed to be university, and is aimed at enhancing research capacity of faculty and students to guide researchers in disseminating, publishing, and applying the research outputs. The Faculty Research Cell is instrumental in organizing webinars, FDPs, MDPs, workshops, national and international conferences over several years. The Stock Market Institute, a pioneer in capital market training in India, emerged out of the jolting experience of losing money in the stock market. They reflect the vibrancy with the mission to be the largest enabler for people to be skilled traders, investors, and to build careers. Since 2009, the Stock Market Institute has facilitated financial market related training and touched the lives of over 300,000 individuals, including students, working professionals, those seeking jobs, and retirees through value-added programs, sessions, financial literacy events, and courses. Understanding the speed towards financial learning and knowing the lack of value addition programs related to financial markets, SMI introduced an app-based learning platform, which is a one-step solution for all financial learning, Indian and international qualifications and certifications. StockBite gives an access to the world of finance learning through one click. I now request Dr. Juhi Jain, Assistant Professor, School of Commerce, deemed to be university, to introduce Mr. Kishore B.S. from the Stock Market Institute.
Mr. Kishore B.S., co-founder and CEO, Stock Market Institute, India. His experiences includes Relationship Manager from 2006 to 2007, Accounts Manager 2007 to 2009, Customer Relationship Manager from 2009 to 2011 in Super Seva Service Private Limited, Venture Partner Basket Operation Group from 2010 till present, Director Key Project, IFM Institute of Financial Markets, UK. Sir has expertise in fintech, markets, trading, and investing. May I now humbly request Mr. Kishore B.S. to deliver the welcome address. Sir.
Thank you, ma'am. Thank you for the opportunity. I welcome all those people who are part of this particular event. Yes, it's a very good opportunity for you to learn and explore world of finance through great speakers who are part of this particular program from different parts of the world. So it's opportunity for you to know what's happening in different markets. At the same time, what will be there as a near future. For example, cryptocurrency is catching up everybody's attention. People want to know what is the right way, or will it become legal, or any other thing. Or there's NFT, metaverse, and many more things that are coming in markets. So we have eminent speakers who have agreed to grace this occasion. At the same time, as valuation for you people, this app is available for next 365 days, wherein you can get to learn a lot of things. As I told you, it's world of finance, which is there in the app. So you can learn all about equities, commodities, investment banking, then Islamic banking, you name it, and it is all there. At the same time, we have regular sessions that keep happening on a day-to-day basis, wherein we have master sessions, live market session, we have sector analysis, we have panel discussion, we have IPO analysis, and many more things that has been planned. At the same time, as the traction gets built, the number of sessions will also increase. So it is just like a big market for you, wherein whatever you want, you can learn and explore. At the same time, certifications are also there on the app. So you can always unlock certificate, which is of value to you, and use it for making your career more better. So we thank Jain University for giving us the opportunity to be part of this mega event. And yes, it is just start of doing a lot of good things. And definitely we would aim to do a lot of good things going forward and bigger things. And it is only possible because of you as users who come onto our app and give us more motivation to learn a lot of new things and do a lot of new things. So with this, I come to end of today's welcome speech and let the speakers and the other dignitaries take it forward from here. Thank you.
Thank you, sir, for giving us such a motivating start to the Global Summit. The strong and energetic force behind our School of Commerce in carrying out various activities is our respected director, Dr. Dinesh Neelkant. As always, sir has been our guiding force in organizing this Global Summit. Unfortunately, he could not be with us here this evening, but sir has sent his best wishes and best regards for this 5-day Global Summit. I now request Dr. Juhi Jain, Assistant Professor, School of Commerce, Jain Deemed to be University, to introduce our Honorable Vice Chancellor, Dr. Raj Singh.
Dr. Raj Singh is the Vice Chancellor of Jain Deemed to be University, Bangalore, with 40 years of experience, including 27 in education. He has been the Vice Chancellor of prestigious universities like G.D. Goenka University, Gurgaon, Amity Jaipur, Amity Gwalior since beginning of 2010. Earlier, he was the Pro Vice Chancellor at Amity University, Noida, Director General of prestigious Amity Business School and Head of ICFI Business School, IBS, New Delhi, from inception in 1995. He has been advisor to many universities across India. He served the Indian Air Force from 1981 to 1994. A consultant, trainer, astute academic administrator, teacher, speaker, and education entrepreneur. Dr. Singh has done his Master's in Economics and CFA, Chartered Financial Analyst, in PhD in Strategic Finance. He is known for his oratory skills and innovative approach in higher education and is a TEDx speaker. A strong proponent of outcome-based inter- and transdisciplinary education and research. He has been instrumental in designing innovative pathways in collaboration with universities globally, like University of Warwick, University of Westminster, and University of California, Riverside in USA, and the list goes on. A trainer and consultant for Indian and multinational companies like Tata's Indian Airlines, now Air India, Telecom Consultant of India Limited, Denso India, ANZ Grindlays, NTPC, GAIL, SAIL, EIL, Birla Soft, Kuder Mukh Iron Ore Company in Karnataka, and others. He has trained over 5,000 teachers in school as well as higher education. Dr. Singh has published and presented many research papers and delivered keynote addresses in over 80 conferences and has been a panelist in many TV shows, featured as one of the movers and shakers on Daily World Post and Mr. Icon on FM channel in 2016-2017. He represented India at the International Design Summit held in Milan, Italy in 2013. Widely traveled and a visiting professor at IIT Delhi, Delhi School of Economics, Jamia Hamdard University, Mohanlal Sukhdia University, Udaipur, and Osmania University, Hyderabad. He has been on the advisory boards of many institutions and universities, Education Promotion Society for India, EPSI, and was the Vice Chairman of Quality Committee on Education of QCI, Government of India. He regularly chairs the Expert Committee of National Board of Accreditation, NBA, and was member of the first Governing Council of the Rajasthan Science Congress. He has been conferred awards for exemplary education leadership in 2012, 2016, 2017, and Peter Drucker Memorial Award 2020. He has developed the unique transdisciplinary project-centric learning at Jain Deemed to be University, which will take education to the intersection of research and practice during Jain 2.0. I now request Honorable Vice Chancellor to address the gathering.
Thank you, Dr. Johi. All my colleagues from School of Commerce, Mr. Kishore from Stock Market Institute. Thank you, Mr. Kishore, for joining hands with us for this summit. And I congratulate Samshodhana for organizing this summit on a very, very contemporary topic. I'm sure it was contemporary when you conceptualized it, but I'm sure after you started, it's become more contemporary in view of the developments globally, what you've been witnessing, particularly for the last 1 month plus. When I was told about this topic of global security markets changing landscape, I was quickly taken to 1990s, just after I had completed my CFA program, and I was still in that mode of students. I vividly remember when Government of India for the first time thought of computerizing or automating the stock exchanges in India. I remember those days we had 22 exchanges and all the brokers went on strike. They said, will not automate. Because automation, one, they were uncomfortable with, and second, there was a lot of training required, and they also feared that some of them might lose job or it may affect their profession adversely. It was, I think, Dr. Manmohan Singh was the finance minister, the architect of all the reforms, particularly stock market reforms. What they did, they established a new exchange called National Stock Exchange of India and said, you may not automate, we will not pressurize you. And friends, what happened within the next couple of years is a history where most of the business by the companies started shifting from BSE and other exchanges to National Stock Exchange. And it was out of compulsion that almost every stock exchange thereafter started investing in automation. And the Government of India did not require any pressure, any motivation, any persuasion. And today we see that Indian stock exchanges are one of the most modern stock exchanges in the world. If I look at next 5-10 years, because that's what we can think, not beyond that. Even beyond 5 years is very, very risky to predict. Out of more than 130 global exchanges which are operational today in the world, and trading in equities, options, exchange traded funds, futures, swaps, and all the derivatives for cash, energy, and commodities. Few factors are very, very clear. Few drivers of the change are very, very clear. But the most dominant one, all-pervasive one, is use of technology. I think all the drivers which I like to mention are primarily driven by technology predominantly. And it is because of this that today we're talking about settlement period. I remember we used to have 15 days, then became 1 week, then became 3 days, and it kept on reducing. The stock exchange used to trade for a limited time. And I remember when we were students, we had the open outcry system. Today, you sit in front of the terminal and trade sitting on the computer. A lot has changed in the last 20-25 years, but I think the future is even more interesting. Before I come to those drivers which will influence the landscape globally as the stock markets are concerned, 3 things in the Indian context will drive the future, the entire financial markets. And these, all of us are aware. Some of us have criticized it. Some of us have seen the political fallout of these initiatives. But they've also seen the utilization or the utility of these initiatives. And the first, of course, is unique identification called Aadhaar. Almost everyone is connected. All the accounts are connected, whatever type of accounts you have. And therefore, it's a great initiative in terms of bringing in transparency and curtailing. I'm not saying eliminating, but curtailing to a large extent the manipulations and scams and corrupt activities. And this is going to take us a long, long way as far as India is concerned. The second initiative which was taken, which is a game changer, was Jan Dhan Yojana, where even the poor of the poorest were brought into the banking system. Every penny which was otherwise not into the banking system was brought into the banking system. India being a huge country, the money brought into the banking system was huge. And that led to a different kind of liquidity, different kind of money in circulation. And the third initiative taken has been digitization. Digitization of not only banking and financial sectors, but almost every other sector. And these three initiatives, if you look at in the long run, are going to drive the future. They're going to give a new meaning, new dimension to the competitiveness of businesses. And in the backdrop of this, if I can mention few drivers of this changing landscape, could be that because of use of technology and greater scrutiny of the governance issues and transparency related issues, there will be a revenue pressure on all the exchanges. And these revenue pressures will be primarily because of the transparency about the fee which they have to charge for the transactions, the tightening margins, they have to operate within very, very narrow margins. Few, not even a basis point, but a fraction of basis points you have to really look at, and they have to enter into large volumes to earn the revenue which they have been earning earlier. And very, very low or negligible switching cost from one form of transaction to another form of transactions, where you can access remotely when you trade in the exchanges. And the second driver of this change is, world over we have seen a very fierce competition posed by the new and the nimbler ones in terms of exchanges with the old and established. This competition is changing the complete economics of stock exchange and the trading in the stock exchanges. The heightened regulatory activities globally, wherein of late it's not only the governance issues and transparency, but I think major focus is on very finer points of risk analysis, where they test the company's resilience, their ability to deal with the crisis situations. We have seen during the COVID what kind of resilience was shown by different sectors, different countries, and the ability to bear risk, whichever company had, could survive. Otherwise, many went out of businesses. And these pressures which I mentioned are also going to lead to consolidation globally among the stock exchanges, which basically emanate from the possibility and the enablement of technology available to us, the new markets they have to expand in, and also they have to innovate new products and services to be offered by exchanges. And in that, one of the deficiency has been till now, which I think in the times to come will become more prominent, is that all the securities exchanges the world over have automated the trading part of it. But non-trading or the operational activities are yet to be automated, or they have much to be desired, and the focus is going to shift there, because the pressures which I mentioned are going to further affect the earnings or the revenues of exchanges, and they have to bring in more and more efficiencies. And the last factor, of course, which was also briefly pointed out by Mr. Kishore, is an evolving digital ecosystem, wherein the incorporation of services and products and more emphasis on the privacy and data security. And this is where the role of blockchain comes in, the big data analytics comes in, cloud, artificial intelligence, machine learning kind of concepts will have an increasing role in the stock exchanges and the securities markets. And there are many other technologies, as was mentioned, non-fungible tools will be more traded in times to come. And the governance issue, let me take you back about 20 years. There was a spate of security market scams or the corporate scams around 2001, 2002. And some of the prominent ones were WorldCom, Enron, we had Xerox, we had Tyco, we had Parmalat of Italy, and around 2008, we had our own Satyam for the first time. India was caught in this series of scams. And then, of course, there were many others, even in Indian context. The governance issues became more important than anything else. And in the US, in 2002, a special act was passed called Sarbanes-Oxley Act. You may be aware that today, every company in the US has to be audited, not only for the accounts audit, but also the information security audit under SOA. And there are specialized verticals with the consulting firms, with the auditing firms, which undertake audit under Sarbanes-Oxley Act 2002. In fact, around 2002, there was a joke going around the entire US and the world, was that in those days, the punishment for a murder was maximum 14 years, life imprisonment. And for those who were caught in committing financial scams, the punishment was 20 years. And the joke going around the world, particularly the corporate world, was that because CFO commits a scam in finance and CEO has to go to jail for 20 years. So what the CEO should instead do, he should murder CFO and go to jail only for 14 years. But that kind of seriousness and the focus, the governance issues came into post 2002, and it has become a part of the audit system. And this is going to become only and only more stringent. Friends, few other things, of course, I can go on and on what stock markets get affected by this and how it shapes the landscape, but few prominent things. And one of them, in the recent past, we were puzzled, how come stock markets and gold prices can go up simultaneously? And we hardly had any answers through economics. But then nobody looked at the kind of forex reserves we built up. As of 25th March 2022, the forex reserves of India were about $617.65 billion. And this is after decline over previous 2 weeks by almost 11 to 12 billions when the Ukraine war broke out. Despite that, we stand, I think, if I'm not wrong, fourth in the world. After China, Japan, Switzerland, we are the fourth in terms of forex reserves. Now, this is a very, very strong kind of reserve which India has, particularly when it is trying to be that $5 trillion economy in times to come. It's well on its way, and the recent developments may well be supporting this. On one hand, while our growth rate has been revised downwards because of the ongoing war and the speculations that it may escalate, the instability the world over, but at the same time, I think there are also possibilities if you look at the purchase of crude oil, rupee may become stronger, and that may really affect our forex reserves and many other economics positively. Now, if you look at the impact of all these economic factors, India presents a very, very strong economy in terms of fundamentals. And in the long run, if you look at the variations and the fluctuations in last few weeks and may continue for next few weeks, long-term perspectives seem very, very positive. And Indian story will be something which the entire world has to emulate. As for students and we as teachers are concerned, out of whatever I have discussed so far, the times have changed, and the times which are passing through now require more scientific approach when we operate in the stock markets. And naturally, when we teach and train our students, we need to use more scientific approaches. It was mentioned that our skills have become an integral part. It will not be sufficient if you only read theories through the books. For example, if you read modern portfolio theory starting from 1950s and then going to 1970s, and with all the assumptions, unless we relax the assumptions and come close to real life, those theories are of no use, even though we have some heuristic methods we have developed in terms of ready reckon tables and the brokers and the traders use day in, day out. But I think the rationale behind that has to be understood. I remember during one of my visits of MBA, I bumped into one MBA student, and she was sitting in the Bloomberg lab. And I went up to her and said, that what are you doing? And what stunned me was that, sir, we have these live terminals of Bloomberg, and I'm working on Yugen Pharma's concept of performance measurement of portfolios. I'm trying to form a portfolio and trying to decompose the risk into systematic and unsystematic, and trying to see which part of risk is because of what factors. Now, students, unless we do that, unless we pick up securities and other tradable instruments from the real life market and form a portfolio, and then perform the analysis in a more scientific way with the help of computing power which we have in our hands today, which was not perhaps 20 years ago, we will be able to measure to the minutest extent, a refraction of a decimal point, what are the margins. Unless we do that, it will be very, very difficult to capture those margins and the variations which we all would like to capture. So I think if I look at this, the way education is being imparted and the way teaching learning will take place will be absolutely different from the way we have had it so far. I remember when I was a student, somebody was telling me that ultimately what is all that which affects the stock markets. And I remember I thought, let me lecture. I've got the opportunity of lecturing for the first time to my family members. And I was saying, it's a very, very complex process. It is affected by what happens to the interest rate as announced by the monetary policy of RBI. It depends on what were the election results of the bypolls or the state elections, as happened in our case recently. It depends on what's the statement by the Prime Minister from across the border. It depends on what are the crude prices, in what direction they're going. It depends on which country the US is going for sanctions against. And I went on and on and on. I remember my son telling me that if you don't know anything, why don't you say so? And then I had to stop because, but then if you look at today, believe me, similar kind of situation exists. What is happening in a neighboring country? Does it provide stability or instability to a country? What is happening in Europe? Does it have possibility of escalation? What statement comes from the US and the NATO countries? All that is going to be factored in how do we price our securities in the stock markets today. And for that, it's not only the timing of entry and exit from the market, which comes through technical analysis, but I think more important will be the long-term view, for which we need to understand how we perform fundamental analysis before we take a position of short run or long run, whether it is economic or industrial company level. Now, this is in some, I think all of you know about these terms, but in some, I can only say that the overall times which are entering into over the next 5-10 years are going to be absolutely exciting. And that's what is more interesting, what's more important point for me. I think it's a very, very timely summit. I thank and congratulate my colleagues from School of Commerce for conceptualizing and putting this conference together. I'm sure all the students, researchers, delegates who have joined from all over the country and perhaps all over the world, including our own students, will immensely benefit from this 5-day summit. And I wish the summit a great success. And I'm sure at the end, you all will stand wiser and enriched. And thank you for having me, Dr. Juhi and Vandana, for this summit. And thank you for bringing me back to my discipline, because when you enter the chancellery, which I've been doing for the last about 12 years now, even though I continued to teach till about 5 years ago, last 4 or 5 years has been a real break. Thank you for dragging me into my subject, which I so passionately love and like. Thank you so much, everybody, and all the best.
Thank you so much, sir, for your valuable words of wisdom and for giving us such an extensive insight about the stock market. And most importantly, for making such a vast topic so concise by adding your priceless experiences to it. This surely makes all of us relate to it to a very large extent. Thank you once again, sir. I now request Dr. Juhi Jain, Assistant Professor, School of Commerce, Jain Deemed to be University, to introduce our speaker for the day, Mr. Jamie Coates, CMT CFTE Crypto Market Analyst for Bloomberg Intelligence and board member with the CMT Association.
Mr. Jamie Coates, CMT CFTE, is a crypto market analyst for Bloomberg Intelligence and is responsible for creating crypto market structure, asset, sector, and thematic analysis content for clients. He takes a multidisciplinary approach to his analysis of this emergent asset class, combining fundamental, technical, quantitative, macro, and on-chain data. Mr. Jamie has over 20 years of experience in the financial markets, starting his career as a stockbroker in Australia. He went on to work as a hedge fund trader and in equity sales. He joined Bloomberg in 2014 as an equity specialist driving operational and alpha generation initiatives within the CIO office and investment teams for APAC by sites. Over the past 4 years, Mr. Jamie has immersed himself in the crypto digital asset space, helping shape the products, offering, and sales strategy. Mr. Jamie also holds a Chartered Markets Technician CMT designation and serves on the global board of the Cmt Association. His contributions towards CMT has been noteworthy as an APAC summit, as an APAC committee member, as a panel member, and as a technical speaker across various summits and conferences all over the world. I now request you, sir, to commence the session.
Hi, good afternoon or good evening, everyone. Thank you very much for that kind introduction, Dr. Juhi. Thank you very much for your presentation earlier, Vice Chancellor. I found it quite interesting. I love hearing stories about the markets in context and history. I'm a student of history myself, and it's really interesting to be here today to be able to present, but also hear some insights about, I guess, some thoughts around where India is positioned within the global financial markets and some of those sort of contextualized insights. So I appreciate that. I'm going to share my screen and start the presentation. So if there is any issue with not being able to see this screen, please let me know, but you should see it now. I think you can see that. Okay, great. So as I said, my name is Jamie Coates, and today's presentation is called Applying a Multidisciplinary Approach to Crypto Asset Analysis. Before I start, I've had an introduction, so I'm not going to spend too much time on myself, but I do want to mention the Cmt Association, and this is a body that I've been involved with now for really the best part of 8 years. So the Cmt Association is, for those of you who are perhaps not aware or not had the opportunity yet to check out exactly what this organization is all about, is really the leading technical analysis body globally, teaching technical analysis, the discipline of technical analysis. And it's a global organization with a very strong presence in India. I run the APAC committee, and I believe the head of Asia at CMT, Mr. Joel Panicott, will be presenting or part of one of the panel discussions today. So I'm sure he's going to elaborate a little bit further, but this particular organization was really instrumental in my career. I came from a fundamental background. I worked with one of the largest or the leading research teams in Australia, covering Australian equities, and I was very much brought up in the tradition of fundamental analysis. But really where my own analysis and investing started to improve was when I was able to integrate technical analysis into the process when I was predominantly trading equities. So this program is something that I'm a very big proponent of. It's a 3-part exam series, which can, as long as you want, really. But I mean, every 6 months you can sit for these exams. So you can finish this program in 18 months. And it really covers the fundamental building blocks of technical analysis, things that you're already familiar with, such as pattern recognition, trend analysis. But it builds the understanding around portfolio management, risk management, statistics, how to build a trading system, how to be a systematic trader. So these are things that I think for some of you out there, you may be looking at or may be interested in. So please do check out the Cmt Association website. Now, just before I move on, a little bit about the group that I work with. It's called Bloomberg Intelligence. Bloomberg, for those of you that are at the university, you're well aware of the Bloomberg terminals that are sitting in some of the investment labs already. But within the Bloomberg group itself, we have obviously Bloomberg News, which is a very big part of the Bloomberg brand. But also we have Bloomberg Intelligence, and this is a team of research analysts, which has grown to over 350 analysts and strategists. If Bloomberg Intelligence was a research department at a bulge bracket firm, we would be probably in the top 5 in terms of the number of analysts within the group itself. So it's very large. It covers all asset classes. And I joined this year to really to become the crypto market analyst. We have already a team of 7 people who are covering crypto from one angle or another. So government policy, from a commodity perspective, from ETFs and funds. But my role is really to focus just on crypto and digital assets and provide a broad base of research product for our clients. Now, the agenda is really pretty simply laid out. I just wanted to share some of the mental model that I use for analyzing crypto and digital assets, and talk through some of the different analytical frameworks that can be applied to relatively new assets. And I think for those of you that are maybe not trading or investing in crypto assets already, and I know that's a slightly controversial area or topic in India, given the somewhat schizophrenic nature of your regulators and government and government in regards to it. It seems to move from lukewarm to warm to very, very cold, quite frequently, oscillating back and forth. But generally, I think this is an unstoppable asset class, which is going to be accepted in one way, shape, or form. So for those of you that are not investing in this space or relatively new, I wanted to share some of the analytical frameworks that I use to understand this market, because it is incredibly challenging. It's new, but it also has a lot of similar characteristics to other asset classes, which lends itself to some old, traditional, familiar analytical frameworks. Now, within the discussion today, I'm going to do a little bit of a deep dive on just Ethereum because of its quite unique characteristics and the way that can be, and way that the asset can be analyzed in a couple of different ways. Okay, so what exactly is a crypto asset? Is it a brand new asset that deserves an entirely different way, or is it a different paradigm and therefore should be treated as exceptional and as unique? Or can we look at it through the lens of some of the traditional asset classes that we're familiar with, commodities, for example, or equities and fixed income? Now, I'm of the belief that you need, obviously, to do your due diligence on all of these assets. But depending on which asset you're looking at, you'll often find that they exhibit characteristics which are shared with some of the traditional asset classes. So, yes, it's a brand new asset class. We are talking about essentially decentralization, something that has not really been implemented before, and either in terms of the ownership structure or in terms of the way economic participants can interact with one another in a decentralized fashion. The assets themselves were developed to be non-custodial, and this is unique as well, with the exception of, I guess, physical commodities. Most assets are custodial. If you are trading equities, you typically have a brokerage account where those assets are held in custody on your behalf. They're new in terms of the way that the assets are secured, the way that the ledgers work. It's using cryptography. So yes, it was certainly with those characteristics, we are talking about a brand new asset class. But when you look at some of these assets, some of these blockchains, you can actually draw direct parallels to other asset classes like commodities. Bitcoin is your classic example. Bitcoin is the first digital asset, and it has really captured the narrative of digital gold. Now, what actually is the defining characteristics of gold or other precious metals? Well, it's the fact that they're scarce. It's the fact that, in order to produce more, you have to spend energy in the form of mining operations in order to extract that particular commodity out of the ground. And therefore, that constrains supply to some degree. It also depends on the natural occurrence of that commodity in the Earth's crust that gives it certain properties of value. Now, on the other side of the coin, you can think about some of these blockchains or some of these protocols that sit on top of the blockchains as equity-like instruments. In many cases, these protocols and blockchains are generating cash flows, right? Owners of the actual tokens or of the coins themselves are effectively shareholders owning the stock of a company. And they're able to exert some degree of control or influence on the direction of the protocol itself through the governance structure that's been set up. We won't get to really go into decentralized or autonomous organizations or DAOs in some way that some of these protocols are governed, but essentially they have characteristics that are similar to an equity ownership. And then, of course, some of these assets, some of these protocols allow you to earn an income stream. If you take a particular asset and you stake that asset to secure that particular blockchain, then you earn a degree of return in the form of a yield paid in kind in that particular asset. So depending on what you're looking at, you will find that you are in completely uncharted new territory, as well as being able to, recognize some traditional asset features and characteristics. So when I joined Bloomberg Intelligence to cover these markets, I just needed a way to basically break down the landscape into my own categories. And the way I've defined the market for myself, and everyone's going to be different on this, is simply that Bitcoin is in its own right a separate asset that really should be distinct and unique from everything else. Bitcoin is essentially, as I said, digital gold. It's a store of value asset. It's got very much commodity-like characteristics, but it's also becoming the global collateral, right? It is evolving into, at least in my opinion, into an asset which will underwrite really a lot of the economic activity that takes place in the traditional world, as well as in the crypto world, in the form of collateral. And there's been some really interesting new cases of this actually taking place in just the last week or so, where stable coins are starting to be backed by Bitcoin. Now, Ethereum is like Bitcoin in that it exhibits some very unique characteristics that make analysis or discerning. You have to add a little bit more discernment to Ethereum because of its unique characteristics than really any other asset in the crypto space. What Ethereum is really looking to become is really the global marketplace for economic activity, online economic activity done in a decentralized manner. So anywhere that you want to buy or sell trade, engage in financial primitives or these DeFi protocols that allow you to borrow, lend, or stake. Ethereum is going to be the place where that is done. Now, everything else that's competing with Ethereum is what I call layer one chains. These are the alternative Ethereums that are, again, vying for being global marketplaces. But because of the way Ethereum has been set up or is transitioning, it has some very distinct differences to those other layer ones. And then on top of that, the final categorization is decentralized apps or dApps that sit with on top of these top of these chains like Ethereum, like Avalanche, Solana, and Terra. And they are your NFT trading apps, your DeFi applications, and so forth. And they very much look like equity and fixed income securities in some ways. Now, the whole space is evolving. So we are starting to see the emergence of classification systems for crypto assets. And this is obviously very welcome because the asset class itself has grown from, a couple hundred coins or tokens only a couple of years ago to now well over 10,000. So just like equity markets and fixed income markets develop their own classification systems, you will start to see that this is going to happen in crypto as well. So I'm showing you here just one example of a classification system that has emerged recently. There are other ones. The point here I'm trying to make is that once you start to see this happening, obviously this is a sign of maturation for this asset class, but it's also going to attract a huge number or an amount of interest from the institutions as well. Because once they can start to break down in a granular fashion these different tokens based on the, the purpose or the utility, then you're able to really opening up the space to traditional analytical frameworks of relative value and relative momentum strategies. Now, the analytical approaches, excuse me, that I'm going to cover in today's session, I guess it's my way of looking at crypto markets, is really to go through some macro analysis, to look at stock to flow, which has become quite a popular commodity-based analytical framework used primarily for Bitcoin and other store of value assets within the crypto space. Third area which I'd like to cover is network analysis. So this really looks at the demand side of the equation, and it touches upon something that I think for most of you, you're pretty familiar with already, which is Metcalfe's law, which is really one of the best ways to understand networks. Then I'm going to touch on some equity fundamental analysis that can be applied. And then finally, technical analysis. And it'll make sense as we go through this as to why I've put the analytical approaches in this particular sequence. So when we're looking at Bitcoin, and I'm really here when I'm looking at macro analysis, I'm using Bitcoin because Bitcoin is still the largest crypto asset. It accounts for 40% of the market cap. That is down quite a lot over the last couple of years. I mean, Bitcoin used to be 70% of the market, but as the market's grown and diversified, that dominance has decreased. But Bitcoin is essentially a macro asset. It was born into the world in 2008, 2009 as a direct response to what was happening in the financial markets. It responds to the monetary response from central banks and also government policy around bailouts, and also a social commentary on developing a financial network which was truly peer-to-peer and trustless, i.e. very, very inclusive. Anyone can sign up. No one could be censored off the network. So in that light, Bitcoin can be treated as one of the best macro indicators that you can really use. And this is something that has been recognized recently as Bitcoin becomes a proxy because it trades 24/7 for macro funds to take a view on the markets over the periods of time when all other asset classes are not trading, like on weekends and at particular times in the night, in the morning. But besides that, Bitcoin has been very much influenced by interest rates or by central bank policy. So here I'm just showing you a chart of Bitcoin on a logarithmic scale, and overlaid as well is the Federal Reserve the Federal Reserve balance sheet, which is in blue. Now, you can see that Bitcoin's periods of most rapid price appreciation are these green areas, the green boxes that I've highlighted. And that coincides almost perfectly to central bank balance sheet expansion. Starting back in 2010 with QE2, and then QE3, which really ended in 2014. And then, of course, the response in 2019, and then the pandemic in 2020, when really balance sheet expansion went, pretty much parabolic. These are the periods where we're seeing Bitcoin, actually perform the best. As soon as you get tightening in central bank balance sheets, then you typically see Bitcoin peak. It typically peaks just before the tightening takes place, because the central bank has broadcast to the market that it's going to start its tightening policy, and that's typically a peak in the Bitcoin price action. Now, what's interesting is that last year we saw the market top out at around 65 to 70,000 in really November of last year. And that was really on the talk that central banks would have to tighten in 2022. As of yet, I don't think we still have a firm date as to when they will, but we expect that it will happen this year. And Bitcoin really struggled for the first 2 months of 2022. And what's quite interesting is that actually Bitcoin has recovered and is looking rather strong on a couple of different indicators, which does suggest that that Bitcoin is starting to diverge a little bit from the macro. However, I think ultimately it's still going to be very much tied to risk assets, and if we start to see excessive tightening from the central planners, then that's going to make that's going to be a non-favorable environment for Bitcoin traditionally. But it's a framework that I've used just to sort of see what sort of regime we're in typically from a macro perspective. But I fully expect that at some point that macro linkage may actually break. Now, if we just drill into Treasury yields, what I'm looking at here is the US 10-year, which is in white, and also Bitcoin, which is in blue. And if we look back at that 2017 period, when Bitcoin had that massive rally from $500 up to $20,000, when yields broke through the long-term trend is basically when Bitcoin also peaked, which, let me just see if I can bring up my pointer here. Okay, so we're looking at this period here. So you had this downtrend in Treasury yields, and then a breakout, which happened really at the end of 2017. Bitcoin peaked. Yields continued to rally throughout 2018. And then as soon as it peaked and started to roll over and it broke through significant support, Bitcoin actually bottomed out. So we saw this play out again at the end of last year. So Bitcoin peaked at around 69,000, 70,000, just as Treasury yields broke through significant resistance again. And since then, yields have climbed quite dramatically in the last, the last 4 months. And Bitcoin, basically, this pullback here is actually a 50% pullback. So, quite significant. Now, at the moment, yields are still firm and rallying. So the move in Bitcoin off the lows in the recent couple of weeks is surprising given the backdrop that we're seeing in yields. So moving along to commodity valuations. Now there's just, excuse me, there is a particular valuation model which has been proposed over the last couple of years to explain Bitcoin's value, and it's called the stock to flow ratio. And this was put forth by a Dutch pension manager, where we looked at the stock to flow model for precious metals and found that the correlation between the market cap and its relative scarcity, i.e. the stock to flow, had a very tight correlation. And it worked, or it was calculated against these precious metals as well as Bitcoin, with a fairly tight fit. Now, stock to flow just means that you look at the stock divided by the flow, where stock represents all of the commodity that has been mined up until now, divided by the supply of that commodity on an annualized basis. So how much actually gets pulled out of the ground per year on average. That is your flow. So that's how you calculate your stock to flow ratio. And the higher the stock to flow ratio, the more scarce that particular commodity is. So gold has a stock to flow ratio of about 62 times, and silver has a stock to flow ratio of 22 times. So you can say that gold is actually 3 times more scarce than silver. Now, what's interesting, and there's a lot going on in this particular slide, but the bottom left-hand chart here is just looking at the supply schedule for Bitcoin. Now, Bitcoin has a set supply, programmatically defined, that cannot be changed, where every 4 years, the number of new Bitcoin that's released into the market, that goes to the miners for performing the validation and securing the network, that number of new coins actually halves. So what you actually find with Bitcoin is that it is a disinflationary asset, meaning every 4 years, less and less of the asset will be mined. And that's what gives it this deflationary supply schedule. So currently, the stock to flow ratio for Bitcoin is around 55 times. So it's not as high as gold. But when we get to the next halving, which is in 2024, that stock to flow ratio actually increases to around 80 or 90 times. So when that happens, Bitcoin will be essentially harder money or more scarce than gold. Now, the stock to flow ratio has done a pretty good job of explaining the price action for Bitcoin up until this point. But there's a couple of flaws with this particular model. Number one is that it completely ignores the demand side of the equation. Stock to flow addresses scarcity and supply, but doesn't actually explain demand. So it is correct to say that if demand for Bitcoin stays the same and the supply is every 4 years being cut in half, then the price of that asset, the value of that asset will increase. Okay, I think we can all accept that. But the stock to flow does not actually explain what is the driver for that demand, or whether that demand is increasing or decreasing. So that's number one. Number two is that stock to flow hasn't really done a great job in explaining the value of other precious metals. So it hasn't necessarily worked all that well in practice. But it is a useful tool to compare other digital stores of values. And you can say that, Litecoin, Bitcoin, obviously, Ethereum are vying for a store of value as one of their characteristics or one of their appeals to investors. And what's very interesting is that as we'll sort of go through this presentation, we talk about Ethereum in a bit more detail, is that the Ethereum supply schedule is going through a very large transition in which not only will it, in the case of Bitcoin, become disinflationary, meaning there will be just less and less supply, there's a very high likelihood that Ethereum becomes deflationary, meaning that every year, more and more coins are actually destroyed, meaning there's less supply. And this is actually, a very big thing in crypto markets that's getting the attention of investors. So let's address that other side of the equation. We've done the commodity analysis using stock to flow, which really looks at the supply schedule or the supply side dynamics. But how do we measure the demand side? So this is where Metcalfe's law becomes actually quite a useful framework for understanding these assets. Now, the Metcalfe's law is, simply put, is the value of the network is proportional to the square of the number of connected users of that system or network. Okay, so this has actually been used to a high degree of success with social media companies and other really prominent network equities. And this can certainly be applied in the case of crypto assets as well, because they are essentially networks. Now, if you look at Bitcoin and Ethereum, I'm tracing out one of the metrics that I think explains the demand for these assets, which is addresses. So you can look at demand for an asset like Ethereum or Bitcoin through the lens of how many wallet addresses there are, how many transactions are occurring on the network per day, how much value is being transferred across the network. These are all very good proxies, and I'm of the view that a combination of all three of these metrics are actually quite useful for explaining the demand side of these assets. But today I'm just going to focus on addresses. And I should just point out here that if you look at how Ethereum has grown to almost double that of Bitcoin in half the time of its existence, you're starting to see something pretty exceptional. Now, Ethereum got to 70 million addresses within 7 years of its existence. And if we compare that to another really well-known network, Facebook got to 70 million addresses, or 70 million users, I should say, within 5 years. So Ethereum is growing at an exponential rate. It's not as fast as Facebook. However, if we know that Bitcoin is being the prominent digital asset that it is, Ethereum is actually growing at twice the rate of Bitcoin, which really explains the utility that Ethereum has for a lot more different use cases than Bitcoin. So I wanted to really understand how addresses correlate to price. So I've taken this data and I've run the analysis, and through various different statistical measures, Bitcoin addresses and Bitcoin price is very tightly correlated. Roughly 83.5%. The square of the users explains about 83.5% of Bitcoin's price variation, and it's roughly the same for Ethereum as well. So in the chart here, I'm looking at the Bitcoin price, overlaid Bitcoin addresses, and then I'm just smoothing out the price with it using a 200-week moving average. And what you'll find is that that smooth price and the Bitcoin address metric as well look very, very similar. Okay, so I know that there's explanatory power in following what's happening with Bitcoin addresses. Are there more Bitcoin addresses being added to the system? Is it contracting? This explains price, not in the short term, but over the longer term. So from there, you can basically create some derivatives. So I've looked at the rate of change. So again, it's the same chart. I'm looking at addresses and the Bitcoin price, but in the subchart, I'm looking at the rate of change of address growth. And you can see that during the 2020 to early 2021 period, when Bitcoin rallied from $10,000 all the way up to around $65,000, that you were seeing a lot of new users, a lot of new addresses being created on the Bitcoin network. And then suddenly that turned negative in May of 2020. And we had that period where Bitcoin fell about 50%. But in the second part of 2021, the growth again resumed, but it was far more moderate, right? That still pushed price up, and we got as high as 69,000. But then it really wasn't the same kind of growth that we had seen in the earlier part of the year. So it did explain why prices weren't able to maintain that level for very long. And we had another 50% pullback since then. Now, over the last couple of months, the growth rate has increased again. And this is explaining, why the prices started to rally. And there's all sorts of narratives that you can build around this. Of course, what's happening in Europe with Ukraine, Russia, what's happened with civil liberties in Canada recently. These are all things that maybe that could have actually turned around the growth rate in the number of addresses. But putting all those narratives aside, the numbers are saying that the Bitcoin network is resuming a strong growth period, and therefore, in most cases, this should correlate to stronger prices. So I've gone sort of one step further, and I've created a dispersion indicator using the same data. So this will just highlight to me when things are extreme in terms of the correlation between the asset and the number of addresses. And I've just highlighted here on the dispersion chart. In this case, I'm looking at Ethereum this time around. And we can see that in 2018, there was quite a large drop in price, but actually we were seeing a huge number of new addresses being created on the Ethereum network. That was a very bullish signal. The price was not reacting to the address information, to the increase in demand, but you knew eventually that it would. And similarly, you can see that when you sort of get very large extremes, that could be interesting opportunities to invest. You can also see when things get overheated. So back in the second quarter of 2021, this indicator was consistently giving overbought signals, meaning the price was moving out of whack. It was getting too strong relative to the number of new addresses on the network. And then it reversed again in the early part of 2022. So again, these are like just two different derivatives of just the one metric to explain the network demand. The other way you can do it is start doing relative analysis using different ratios. So in this instance, what I've done is I've looked at the price or the market cap, divided it by the number of addresses to give me a ratio which allows me to do comparative analysis across the other layer one chains. So you can see here that Ethereum is roughly 2,500 per address, whereas DOT, which is the native token for the Polkadot chain, is 22,000, so almost 10 times more. So in terms of a relative value, Ethereum and Solana are priced more competitively to the activity than you would say something like a Polkadot. Now, I'm going to talk you through some other sort of non-traditional demand metrics and show you how you can start to build ratios with that to try and give you some understanding whether an asset is overvalued or undervalued. So if we look here at the number of protocols on each chain, what we can see is that Ethereum, by far and away has the highest number of protocols, number of applications working on their chain. So that tells me, obviously, that Ethereum is the preferential blockchain for economic activity. Now, these other chains are some of them are starting to see quite strong adoption, such as Avalanche. And you can turn these into ratios again to give you a sense of how cheap or expensive a particular blockchain or asset is. And we can see here that Avalanche is actually quite attractively priced based on the activity, the demand from developers to build protocols on their chain. Similarly, you can look at the number of developers on each chain. So you can get this information from places like GitHub, and we can see here the number of developers building as a function of price to get some sort of comparative analysis. And in this instance here, we can see that Polkadot is actually the cheapest asset. So whilst in the previous chart, if we go back here, there's not a lot of end demand for Polkadot at the moment based on this ratio of price to per address. We can see that actually there are a lot of developers building. So typically the developers will lay the groundwork for the final end demand. If developers are building protocols and building use cases for that chain, then you should typically see an improvement in the number of addresses. So end demand starts to increase. So these are all things that you can just be aware of. Now, I'm going to switch to equity fundamental analysis because I think for most of you here, this is probably your background. This is an area which you're going to find, really quite familiar. I guess the first thing to think about when you're looking at these assets is you would apply the same kind of due diligence that you would apply to buying a company in a bottom-up fashion. You have to do your due diligence, understand what is the company or what is the protocol in this instance actually addressing, what is the purpose, what is the total addressable market of that idea. You have to look at the tokenomics, and this might be something that's new to a lot of you, but tokenomics really just means the issuance schedule for that particular token. So obviously something that has a very high inflation rate, where they're issuing a lot of coins over a short period of time, will be very destructive for the price unless it's offset by an equivalent amount of demand. So taking into consideration what is the inflation schedule, what is the issuance schedule is incredibly important to the success or failure or to the price action of these assets, and also how they distribute the cash flows. We're going to come to this in just a second, but tokens and protocols and chains are producing revenues, they are producing cash flows, but they distribute those cash flows in different ways depending on the governance protocol for that particular asset. So there are lots of different things that you can use to do that bottom-up due diligence when you're looking at an asset. Now, as I mentioned, these protocols and these chains are producing cash flows, and this is something that I still feel that the traditional markets have yet to fully comprehend and understand, because the common argument or criticism about these assets is that they're backed by nothing. Well, it's not the case. There's lots of different philosophical as well as financially sound arguments to say or to explain why they're not, backed by nothing, that they actually are backed by something, but it varies depending on particular protocol, particular blockchain that you're looking at. It also depends on what type of consensus mechanism that chain is using. So there are two main consensus mechanisms. There is proof of work, which is what Bitcoin is the best example of proof of work. Ethereum is also proof of work. However, that is changing this year. It's transitioning to another consensus mechanism called proof of stake. But essentially in the proof of work blockchains, the miners who secure the network and validate the transactions, they are paid in the form of new issuance, right? So new Bitcoin. And they also receive 100% of the transaction fees that are charged when you move money on the network. Now, Bitcoin is, you can move huge amounts of value, billions of dollars for a couple of dollars in terms of transaction fees. So the fees are very low on Bitcoin. So most of the revenue that's earned by the miners comes from the new issuance, the number of new Bitcoin that get produced every single day. Okay, which is, it's about 6.25 per hour, I think. Now, proof of stake completely changes this model. It doesn't require miners using hardware to secure and validate the network. What in fact happens is that the owners of the asset, so in the case of, let's use Ethereum, for example, when it transitions to proof of stake, you will be able to take your Ethereum and lock it into a smart contract. And that will help with the validation process on the blockchain. And in return for that, you will receive new issuance of coins, as well as a portion of the transaction fees. So all of the revenue that used to go to miners will go to the owners of the asset, the stakers of the asset, okay? So these chains, just to reiterate, are marketplaces. And to do economic transactions on these marketplaces, you are charged a transaction fee. That transaction fee in proof of work goes to the miners, and in proof of stake goes to the owners who stake their coins. So this is how you can start to think about some of these chains as more equity-like instruments. Now, that is revenue and cash flow. Do these assets make a profit, a literal profit? Well, again, it depends on the particular blockchain. It depends on the particular protocol, because in some cases, a protocol will take that revenue, those cash flows that have been generated on its protocol, and it will pay out some of that revenue to economic participants who don't necessarily own the token for that protocol. And the rest will go to the owners of the token, the governance token. So you have to look at the split between revenue and the after effects of paying out some of that revenue to participants, and that is your net profit. So what does all this mean? It means that you can apply price to sales multiple, price to earnings multiples to these assets, which allows you to do comparative relative value. So is it important to actually track the revenue of these multiples? Well, just like any equity, the success of the company's price or the price performance is strongly linked to the profitability, the revenue generated capability firstly, and then obviously the operational profitability of that particular business. And we can see here that if I'm looking at a chart of a protocol called Aave, which is one of the largest lending and borrowing protocols. It's a DeFi protocol. You can see that the price action overlaid with the total revenue is pretty tightly correlated. Now, the difference here with a decentralized or crypto asset is that you're able to see daily revenue streamed live. And that's very different to everyone who is familiar with equities, whereby you are generally waiting every quarter, every 6 months, every 12 months to find out what is in the company statements as to how much revenue collected and what was the profitability. With these assets, you're able to see that in real time, and this is revolutionary. So again, you can then take those revenue numbers and rank all the assets based on price to sales ratios. Now I know that this particular screen is a little bit blurry, but the price to sales for some of these some of these protocols and these chains are in the 40,000 range, but they also get down to sort of around 80 or 70 times as well. Now, here I'm showing you a subset of the market, and I'm doing a comparative analysis between the decentralized exchanges called DEXs and the traditional global exchanges, right? So the global exchanges that you're familiar with, such as the London Stock Exchange, the Hong Kong Exchange, CME, NASDAQ, Intercontinental Exchange, and so forth and so forth. Now, for some of and I've just highlighted on the visual on the left, a couple of assets which are decentralized exchanges. So these are marketplaces where you can buy and sell tokens, and you can also buy and sell derivatives, futures, and also options. Now, these particular protocols are trading on a price to earnings multiples of 15 to 8 times, right? So 15 to 8 times. And when I did the analysis versus the global exchanges, I'm actually seeing the global exchange average PE, right? Trailing PE of 30 times. Okay, London Stock Exchange trades on a PE of 70 times. Some of these decentralized exchanges are trading less than 10 times. And I think this is quite fascinating that you can actually perform this kind of analysis and actually do a comparison between traditional and crypto assets that are essentially within the same category. They're exchanges. Okay, so moving on to Ethereum. And this is really quite an interesting use case to be talking about in 2022, because this is the year in which Ethereum transitions to, as I mentioned, proof of stake. Now, this is on the left-hand side a visual of the proposed product path for Ethereum this was created at the end of last year, so the dates are a little bit off because things have been pushed back. But essentially, the proof of stake chain will become the dominant chain for Ethereum at some point in the second half of 2022. And when that happens, as I mentioned earlier, the way in which cash flows are distributed across the network is also going to change. So on the right-hand side, this is just a visual I've used, sort of a mental model for looking at how network demand for Ethereum will drive increases in transaction fees that will be split between, will be split into staking rewards, which you can think of as a dividend, and also what we call a supply burn, which is the equivalent of a buyback. Now, in order to increase the value of a particular asset, the best mixture of demand and supply dynamics is to see increasing demand with decreasing supply of stock. And based on the current projections, Ethereum is going to basically be burning more tokens than it issues every year. And the staking rewards, which were previously going to the miners, will start flowing through to the holders of ETH that have staked in these smart contracts. And this is a very interesting dynamic. And because you can actually model Ethereum's cash flows, you can do things like discounted cash flows, DDM models, for example. So in this instance, I've just done my own DCF on Ethereum. I published a report on this a couple of weeks ago, which was quite highly read, because I think for traditional investors, they're not yet aware of the mechanics of these protocols and how they're generating a yield, how they're generating revenues, and how that can be modeled similar to an equity. So, I mean, obviously a DCF is totally dependent on the inputs and the assumptions. I tried to be as conservative as possible. I used a couple of different DCF methods, and I got a valuation anywhere between sort of 5,500 and 9,000, which is obviously higher than where the asset is trading at this point in time. The point being is not necessarily what is the actual valuation at the end. It's that you can model these assets in very familiar ways. Now, you can also look at the income potential for Ethereum. If you do the calculation, this is looking at Ethereum based on comparative price to earnings multiples of high growth equities. So Ethereum's currently trading on a PE multiple of 32 times. If we're assuming that with the mergers happened and we're proof of stake, we're already in proof of stake, and that the stakers are receiving the staking rewards, then currently the price to earnings multiple for Ether is around 32 times. right? So the current price is around 34,000. But if we were to put Ethereum on a price to earnings multiple of Amazon, Disney, or Tesla, you get valuations obviously much, much higher because these things are trading on, very high PEs relatively. And the interesting thing is this does seem to me that Ethereum is undervalued because the growth rate in Ethereum has been exponential. It's been growing its revenues at over 200% for the last 5 or 6 years. You can also look at the Ethereum from a income generating perspective as well, because obviously that staking that staking reward is paid in Ethereum, which gives you an Ethereum yield. And based on where the current projections are for how many Ether will be staked, once we go into the merge, proof of stake, the staking yield could be as high as 9%, but based on your assumptions, and some others have got a little bit more bullish assumptions, it's like well over the double digits. And as staking increases, that yield will come down over time. But still, in the current market or environment, at least where yields are, even though they've risen quite a lot, that's a pretty attractive yield. Now, the other thing here is that I've mentioned is that the buyback part of this equation as well, which I've not modeled in my DCF. But if we just look at it and look at the number of Ether that's going to be burned every day or every year with the transition to proof of stake, Ethereum's total supply, which is around 118 million, is probably going to decline to around 110 million in the next 5 years. So that's a 10% reduction in the number of outstanding Ether, which would make it a harder form of money, a more scarce asset than even Bitcoin, which has been really built its narrative around being digital gold. So I think all of these things sort of make Ethereum a very, very unique asset. And I've taken you through a couple of different analytical frameworks that I use, and it's certainly, still scratching the surface. There is a lot of other interesting angles and interesting frameworks to actually apply to some of these assets. But this brings me back to the final part of today's presentation, which is really, what is the single source of truth? I mean, we can all do DCF models, dividend discount models, stock to flow models, and anything else that we can think of to try and wrap, some sort of framework around these relatively new assets that have very distinct characteristics. But I still feel that the number one framework or model to use to analyze the markets is and always will be price. Price is the only arbiter of truth. Whilst valuation and price do become delinked over time, or sort of, price can not necessarily reflect the value of an asset, whether it's overvalued or undervalued. Price does give you a pulse on the market in terms of what it's thinking, and that alone can actually prove to be a very effective model for trading these assets, especially because of the volatility of these particular assets. So this is where technical analysis comes in, and why I've always been such a very big proponent, because even though they may develop a very strong thesis or narrative for why an asset is undervalued, such as the case of Ethereum, where I've done DCF models, I've done DDMs, there's all these other different approaches which do paint a very bullish picture. Ultimately, the price action is the arbiter of truth. So you can use different technical analysis models to really, give you a signal for when there is an uptrend or when there is a downtrend. And essentially, at the end of the day, that's all technical analysis is. It is telling you when is the most risk opportune time to enter or exit, but it also strips out a lot of the noise and tells you whether something is outperforming or trending. And I've just developed a very basic triple moving average crossover system to analyze Bitcoin and Ethereum and all of these other crypto assets. And I've backtested this across the the time series that we have on the Bloomberg terminal, and it's proven to be quite a profitable strategy. It delivers better risk returns, better risk-adjusted returns than the crypto assets themselves, which is pretty remarkable given how well they've done. But importantly, it lowers the volatility. So when we look at what's happened over the last sort of 1 year or so, if we go back to 2020, when Bitcoin really started its move, it correctly identified the start of the trend. And this, wherever you see a green arrow, is a buy signal, essentially. So this trading system is just a long-only system. It doesn't go short. So it tells me when the trend is starting to go long. And then it also tells me when to exit, when that momentum starts to shift. So here you can see that it rode a pretty good chunk of the uptrend wave from 10,000 all the way up to around 35,000. And then it got stopped out, and then it got back in at sort of 35,000 and took us all the way up to sort of 60,000. And importantly, it missed the big drawdown of 2021. It got us back into the trend as it started to move up in the second half of 2021 again, and then got out at around 59,000, again missing the 50% drawdown that the asset had. And then just recently, it's given a new bullish trend indicator. And I've done this for Ethereum as well, and Ethereum actually gave an earlier signal than Bitcoin about a week and a half, 2 weeks ago. So it's been long for about that time. And the reason why I show these systems is that technical analysis can be performed in many different ways through discretionary trading application or through systematic rule building. And I tend to sort of lean towards the systematic approach because I'm very aware of cognitive biases and behavioral issues that can actually stop us from taking a position or not reading the signal. And this actually just eliminates a lot of that second guessing, because ultimately these systems have performed really well over a long period of time. So that's how I sort of look at those two assets. But then when you're looking at trading or investing across a greater list of assets, maybe you're looking at the top 50, maybe you're looking at the top 20, maybe you're looking at the top 100. You need to have a systematic approach for ranking the opportunities that you have. And one of the ways, or one of the things that you learn with the CMT program is relative momentum, to look at investing in the strongest assets with the strongest momentum. And if you rank all of these assets versus a benchmark, in this case, it would be something like Bitcoin, or you could use Ethereum, then what it allows you to do excuse me, is find those opportunities, where the coins are actually outperforming the larger assets. So that's what I typically do. I rank all of the assets relative to Bitcoin or relative to Ethereum. And then from there, you can apply the same kind of trading rules as I applied to both Bitcoin and Ethereum. In this case, I'm going to show you two charts, which is on Solana and Terra, just because they were at the top of my rankings this week. And in both instances, if you look at the chart of the asset and the chart of the asset divided by your benchmark, so in this case, it's Bitcoin, then you get double confirmations when you're trading these assets for when there is a better risk reward or a opportune time to go long. And that's typically when you get a breakout on the relative chart, which is the bottom chart here, and you get a breakout on the on the absolute price chart as well. So you can see for Solana that was roughly around 2 weeks ago when we got that signal. And then here for Terra, we got that actually back in February, it broke out. So it was outperforming all other crypto assets and obviously in an uptrend, in an absolute uptrend. So that is just one way you can apply technical analysis. And really the holy grail is you build a very strong fundamental narrative, but then you use the technicals as your overlay, as your arbiter of truth to identify how to rank these assets based on the relative opportunity and when to enter and when to exit. So as I mentioned, there are plenty of other areas or frameworks that you can use to analyze crypto assets. So, you can look at it from an ESG perspective. There's a whole new data set called on-chain analytics, which is worth exploring. And again, some of these assets are yielding assets, so you can look at it from a bond perspective or pricing them like a perpetual bond. So there's lots of different ways you can tackle it. So I know that my time is up. I'll stop there and see if there's any questions.
Okay, cool.
Participants, please note, if there are any questions, you can post them on the chat box.
Well, look, if there's no other questions, feel free to reach out to me if you want to follow up on anything that I've mentioned here today. You can reach me on Twitter, and also, okay, some questions are coming in. Should I answer these, Vandana?
Yes, sir, please.
Okay, so the first question is just about what are the possibilities for Bitcoin entry in India? What are the possibilities for regulations? So, look, I'm not an expert on Indian regulations. The latest thing that I'd heard is that that crypto transactions or crypto assets could be held privy to a very high tax rate. There's also talk about a transaction tax for moving coins on some of these networks, but you really have to follow up, domestically, because what's happening in India seems to be changing day to day. But I think it's overall moving in the right direction. Question here: how to start buying Bitcoin as a student? Again, that's subject to local laws and regulations, so you'll have to follow up yourself on that one. What are the moving averages that I've used in my system, and how do I decide on the stop loss? So I've just used some non-optimized moving averages. So you basically can just play around with that yourself. I use a 50-day, a 30-day, and a 5-day, just because they're nice round numbers. So you can see, so I can't be accused of over-optimizing the system. And the stop loss is really, that's a different sort of discussion around risk management, but you can use volatility stop loss. There's different techniques. You can risk a certain amount of capital at each time, but that, again, that's like a broader discussion. It's probably outside the scope of today. Let me just see if there's one or two more other questions. Okay, so I mentioned that there is no cost in the blockchain, and that gives enough room for manipulation. How does a regular deal with that? China, Russia already have put a ban on the same. Look, I mean, this is a really controversial area, and it's not for me to say what any country should or should not do with respect to regulations, but where you find the most open economies in the world generally, and for many years, Bitcoin has been an accepted part of the financial ecosystem. It's either treated as property, it's either treated as a commodity, or it's either treated as a financial asset. And really, the question is how to tax it, not how to ban it. And I think that's the way the world is moving. Obviously, China and China's moving in its own direction. Russia, to my understanding, has not outlawed cryptocurrencies. It has, I think, outlawed Bitcoin mining, but I don't think there's a ban per se. But again, I could be wrong. But really, you want to look at, I think, the Western countries, and they are moving far more towards welcoming crypto because of the innovation that it's providing, because of the jobs that it's creating, and because it addresses the inadequacies of the traditional financial industry, which has, in many parts of the world, failed to provide banking services to the poor and impoverished, and also, does not provide any inflation protection for people in economies where they constantly inflate their currency, destroy the value of their currency, and Bitcoin and some of these other assets address that as well. So that's just my opinion. Governments will do whatever they want to do, but generally I feel that the trend is moving in the right direction. And I'm just seeing if there's any other questions that we've got time to answer. Okay, so I think I've pretty much answered it. Obviously, if you want my slides, I think, Vandana, is that something that you're going to send out, or I may need to get them. I may need to get it approved by my legal and compliance before I do that. But if they can be sent out, then I'll make sure that they're available through the university and you can access them.
Participants, are there any other questions? So there's just one question that's come up on the chat box.
I think that last question is just about regulations again.
Yes, sir.
So, that the second part of the question that's on the chat is, how will crypto exchanges be regulated? That's really the weak link, I guess you could say, for the crypto ecosystem, where those exchanges are the most susceptible to regulations. So, cryptocurrencies or crypto ecosystems were originally developed to be peer-to-peer and completely decentralized. So you can operate on these networks in that fashion by creating a wallet and then interacting with decentralized exchanges. But if you're operating on a centralized exchange, then that's a traditional business that's going to be under the purview of the regulators. But I think what's going to happen is that there's going to be a recognition, given the sheer size of volume and trading that's happening for these assets, that these crypto exchanges are going to become the next powerhouses of the economy, of the financial market. If you look at Coinbase and some of these other exchanges, they're rapidly evolving into what looks and feels like a traditional bank. They have a very active user base, and I know for a fact that several of them are applying for banking licenses in the US. So I think the trend is, or the die has been cast, where these exchanges will become regulated. There'll be KYC. Most of these exchanges do this already. So the whole industry is cleaned up over the last sort of 2 to 3 years. They're all doing KYC. They all have the correct AML procedures in place. And because they are doing the kinds of volumes that are starting to rival the volumes of traditional exchanges, traditional equity and commodity and futures exchanges, that suddenly I think you're going to find that they're going to become a very powerful lobby group, but they're also going to become targets for some of these traditional exchanges to get into the asset class. And I think, everyone's looking at the margins of these businesses and thinking, this is actually a way for us to, engineer growth by getting involved in crypto. So at this point, I hesitate to say it's unstoppable, but we're getting very, very close.
So there's another question that talks about how cryptocurrencies in India show an overall decline in the year 2022.
Sorry, just repeat that question for me, please.
Does the legitimacy of cryptocurrencies in India overall show a decline in 2022?
Does the legitimacy of cryptocurrency? I'm not really sure what that question means. Does the legitimacy of cryptocurrency in India overall show a decline from India? Perhaps the person can rewrite that question because that is not clear. Yeah, sorry. That question is not clear, so I can't really answer it.
All right, sir, no problem.
Okay, well, it's impossible to get a presentation and not have someone bring up Doge and Shiba. So my very quick thoughts on this, there's so much excess money in the system through all the money printing that this is just one of the, outcomes of that. So will they last? Look, I wouldn't want to predict the downfall of a particular asset. It's incredibly hard to predict, and there seems to be more and more coming to market. So there's some sort of demand for it. It doesn't make any sense to me. They don't have any economic purpose other than as a meme. But let's face it, we live in a world where memes have power, and some memes have market caps of $50 billion. So who knows? There's a question here. What is the possible outcomes to be expected out of Bitcoin in the near future? Do you think, considering Ethereum's existence? Okay, so look, Bitcoin is growing in stature. What I mean is that it started as a purely retail speculative asset. It's turned into many people's saving mechanism. People save in Bitcoin because it is not being devalued. So it's a complete reversal of the traditional mindset of how to create wealth or how to protect wealth, and to change the unit of account from your local currency into Bitcoin is the start of a transition of this asset into a global asset, a global store of value. And we'll see it become collateral for businesses, companies, countries, pension funds. We're already seeing it becoming legal tender in one country, and there's various countries that are trying to push through legislation in their domestic parliaments to make it legal tender in their countries as well. We're seeing Bitcoin be collateral for stable coins. I think its future is very, very bright. The question also mentioned Ethereum. Ethereum serving a totally different use case. It is, it's designed to be the global marketplace, but because of its transition to proof of stake and the way it becomes a deflationary asset, that it could do very, very well relative to every other crypto asset over the next 12 months. And that's something that I've been writing about in my research reports. But Bitcoin is serving a totally different use case. And that's the wonderful thing. I mean, all these other chains, whilst they have varying degrees of quality relative to Ethereum, do in some instances serve a purpose or fit the market where Ethereum fails to address a certain use case. And so it's quite likely that in the next couple of years, we'll see a multi-chain world where a lot of these chains basically communicate with one another. You can move assets and you can move economic activity across them seamlessly. It's not very easy right now, but they're building the technology to do that. So, I mean, it's a question of, the product market fit for a particular asset. Bitcoin is not trying to be the smart contract platform of the world. It's trying to do really one thing, and that is be, a store of value, a pristine collateral. And Bandana, I'm going to have to wrap it up there. It's 1 a.m. in the morning, so I'll have to ring the bell.
All right. Thank you so much, sir, for sharing with us your insightful expertise, and also most importantly for taking time out from your busy schedule and being with us here this evening, and for you late at night. Thank you so much once again, sir. Dear participants, please note that the feedback link is posted in the chat box, and the feedback link is also posted on the YouTube description. For those of you who have to fill it, please make sure all of you fill it immediately. Thank you once again for attending the first day of the Global Summit. Looking forward to see you all tomorrow with the same enthusiasm at 6:30 p.m. Have a pleasant evening, everyone. Thank you. Requesting all participants to turn their videos on for a group photograph. I repeat, participants, please turn your videos on for a group photograph. Requesting all participants to fill in the feedback form immediately.